we got to talk about the correlation between stocks and oil prices being on the rise, because one of the biggest takeaways I would say David and I had last week, so many people said, listen, oil prices are clearly headed, for quite some time in one direction, but you're going to see a big positive. Think of all the industries, the consumers, this is going to help. When?
Right. So our economists believe that it's definitely something that takes several quarters to pass through. And I think there are a couple things to take into account that are going on right now. And the first thing is that we've had all of these changes in foreign exchange. So the dollar has continued to strengthen. It hurts U.S. exporters. It's also hurt demand for oil in China and other emerging markets. So the other thing to take into account is that we've had a lot of subsidies that have been removed over the last couple months. Taxes are changing, so the pass-through of lower oil to the consumer has been muted in many different places around the world. It's been more it's come through much more in the United States, but it's not been as much. I think the other thing to take into account is that when we see this very high correlation between oil and the stock markets, it's important to understand what's causing it, because they can be the same thing, and it's difficult to disentangle what's correlation and what's causation. So right now what's going on is that oil is moving up and down in relation with the stock market, because it's a demand side issue that is driving both oil and the stock market. When it's a supply side issue that's affecting the oil market, then we can see that correlation start to break down.
Bob's?
We've also seen a lot of economists reversing their position on the impact of declining oil. The traditional thought is it's a tax cut because people are spending less money. In reality, what they're finding is they're spending back to spending more money on fuel. Oil accounted for 2.5% to 3%, fracking itself accounted to 3.5% of all GDP growth and was good for about 0.3 to 0.8 total component of GDP. When that grinds its way down to almost nothing, when you look at the number of wells that are being drilled but not completed, which has reached almost 200 days of not being used, people are spending $20 million, they're putting a cap on the hole and they're walking away because it's not worth it. They're still punching the holes in the ground, so the supply is there if and when the demand makes it worth your while. But I think people have gotten that, I think people have reassessed, to your question, Stephanie, the importance of fracking and realizing that actually the U.S. is a domestic producer, and this oil price is hurting us, outright hurting our GDP.
So Michael, supply or demand or both?
It's both, but I think that right now demand side issues are dominating. What we've seen since the middle of December, beginning of December, is that even though we were coming into this time frame during Q1 where Iran is coming back, the market has known about this for quite some time. So it's very difficult, obviously, to disentangle demand and supply. But when you look at what the trend has been for demand growth over the last 8 quarters, we really haven't diverged very much for physical demand for crude. But what we have diverged very much from is the physical supply of crude. So we've seen 2-3 million barrels a day more oil supplied than demanded in almost every single quarter, and that's expected to continue during 2016. And we only expect that margin of difference between global supply and global demand to start to dissipate by the 4th quarter.
Well, while it's not easy and nobody has a crystal ball, it seems that more and more people are weighing in on where they think oil prices are going, and investors are dying for that answer. Our European colleagues spoke to Pierre Andurand, who said that $50 a barrel is where we're headed at the end of the year. Take a look.
My best guess would be that we are bottoming pretty much now. We are not going to go back up very fast, but I believe we'll probably go to $40 by the summer and the year up to $50, and probably go up to $70 next year and higher after in 2018.
So Michael, I want to come back to something you've raised. If you're going to get that $50 a barrel, you're going to have to get the demand up, not just the supply down. And I had not focused, I must say, on the extent to which subsidies are coming off in some countries or taxes are going on. And even China, I think, within the last 24 hours or so, indicated they're not going to be stimulating demand for gasoline.
Right. I mean, the real estate sector in China is collapsing. I think what we have to pay attention to as we move into the summer is that drivers are still going to get out on the road, and they're going to get on the road at a much higher rate last year versus this year. So, the thing that we have to take into account is that the demand side is continuing to be spurred by these low price levels. Supply is starting starting to contract. Rig and drilling activity is down. So as we get into the end of the year, the market is going to tighten and the balance tightens, and that brings us back up, in our view, into that $45, $50 range by the first quarter of 2017.
Travis, we got to talk about what this means, though, for sovereign wealth funds. Those investors who have been bulletproof, all of a sudden when you're seeing them start to sell out of assets, it's making people concerned.
Absolutely. The Russians, the Russians have unwound. SAMA was announced. If you looked at SAMA, it lost around 150.
SAMA?
I'm sorry, the Saudi Arabian Monetary Authority, good point, had sold off over $100 billion worth of dough. In total, sovereign wealth funds have around $6.3 trillion. They're
but it's
three
not just
times
Russia
all the
and
world's
Saudi Arabia. This is suddenly hitting Norway. You're seeing it in the Netherlands. You're seeing it in Temasek.
And the reality is that it's about 55% oil countries, that were setting aside money for when the oil ran out, not for when the price plummeted, but for when the oil ran out. So it's occurring on a different